70% chance of price collapse. That's not a weather forecast. That's what analysts are now saying about Central Florida's housing market. And while the governor stands in front of cameras promising prosperity, the data tells a very different story. The sunny skyline of Central Florida, vibrant, full of life, new construction popping up like mushrooms after the rain. But behind all that gloss, something is shifting. The boom that once felt unstoppable is showing cracks. Today, we're diving into the hidden drama, how the Central Florida real estate market is quietly imploding and how the state's top leader is scrambling in response. The story begins with unrealistic expectations. For years, Central Florida's housing market rode wave after wave. Low interest rates, pandemic migration, people fleeing high-cost metros, and developers raced to build. But data now shows the energy is fading. According to real estate analytics, Florida markets like Tampa, Orlando, and several surrounding metros are flagged as very high risk for price drops, some with over a 70% chance of decline. Meanwhile, inventory is climbing, days on market are stretching out, and the rush to buy frenzy has cooled. Now picture the governor. The stage is set. He's meant to be the steward, the voice of confidence, the man who tells investors, yes, Florida is safe. Yes, this market is still strong. Yet behind closed doors, panic is creeping in. Because when a region that's been booming starts showing signs of collapse, the implications are massive for homeowners, developers, state revenue, and political fortunes. Let's break down why the market is faltering, how the governor is reacting, and what might come next. And I promise you'll see why this isn't just a local story. This could signal broader tremors across the U.S. housing market. First, what's causing the slide? There's no single villain. It's a collision of many forces: affordability breakdown, rising insurance and maintenance costs, especially in hurricane-prone Florida, shifts in migration, and oversupply catching up to hype. One report warns that Florida's sunny Zoom towns, once the winners of remote work migration, are no longer drawing the same crowds, leaving sellers scrambling. Another flagged map of risk zones highlights Tampa, Winter Haven, and Palm Beach Gardens as among the highest risk metros in the U.S. for home price declines. And analysts say what's happening isn't a tidal wave crash yet, but a reset or rebalancing of inflated expectations. Let's talk specifics. Mortgage rates are higher now than they were during the boom. Insurance premiums have skyrocketed in Florida thanks to climate risk and severe weather events. That means even if you can buy a house, the cost of owning it keeps escalating. One long-term outcome, some homes are languishing on the market. According to one analysis, nearly 900,000 new homeowners across the U.S. are underwater on their mortgages as home values dip in some locales. In Florida, the signs are clearly visible. One report says home prices peaked in spring 2024 and have since begun to decline. Though modest, the concern is upward momentum has stalled. Now flash to the governor's office. He has to walk a tightrope. On one hand, maintain confidence. Developers, buyers, out-of-state investors are watching. On the other, respond to the rising alarms, because if the housing engine fails, the ripple effects on state tax revenue, jobs in construction and real estate, and even migration patterns will be profound. There are some telling public moves. For example, the governor publicly predicted property values would skyrocket if a certain political outcome happened in New York City, referencing relocation patterns from high-tax states to Florida. But juxtapose that with the industry whispers. Builders offering incentives, rate buy-downs, closing cost help, the sort of actions you don't take when you're confident the boom is endless. So what's really going on behind the scenes? The governor appears to be hoping for a rebound through incentives, by promoting migration, by signaling stability, while also quietly scrambling to manage exposure. Why this matters? Because the housing market is often the lever for middle-class wealth, and when it stalls, confidence erodes. Think of homeowners who bought in the boom expecting rapid appreciation. Now they may face stagnant values, rising costs, and a tough decision: stay put, sell at a loss, or walk away. That creates pressure, and when such pressure builds in one of the most migration-driven states, one that has long sold itself as the place to buy. Well, the political stakes are high. Let's walk through the narrative of how it might all unfold. Scene 1. The hype era. For years, Central Florida neighborhoods saw bidding wars, multiple offers, construction cranes everywhere. Investors came in expecting endless growth. Migration trends supported it. Insurance seemed manageable. But then, the undercurrents changed. Scene 2. Softening signals. Reports show inventory rising, days on market lengthening, price gains flattening and then dipping. In effect, what looked like a one-way ticket up turned into a two-way street. Homes aren't flying off the shelves anymore. Buyers are more cautious. Sellers are asking harder questions. Data suggests the Sun Belt boom could be ending. Scene 3. Pressure builds. Homeowners priced for a boom feel uneasy. Builders and developers shift tactics, incentives, lower margins. Local economies tethered to construction and real estate feel the impact. The governor hears the buzz. Economists saying rebalancing, not crash, but still, risk is mounting. Scene 4. The governor's move. He steps into public view, making bold claims, issuing reassurances, possibly pushing policy levers, tax incentives, regulatory adjustments, marketing Florida as the safe bet. The messaging, we're still strong, we're still open for business. But behind the scenes, budget forecasts may worry about lower growth. Local municipalities might brace for reduced property tax growth. Insurance debates intensify. Scene 5. Possible outcomes. In the best case, the market finds a new equilibrium. Moderate growth, stable values, buyers and sellers meet halfway. In a worst case, values slide further, inventory swells, homeowners hold on to properties longer, new buyers hesitate, and the risk of broader contagion increases. That's why the governor's panic makes sense, not because collapse is inevitable tomorrow, but because the costs of being blindsided are so high. So what should viewers, homeowners, investors do now? First, temper expectations. If you bought expecting rapid gains, recalibrate. Stagnation is a realistic outcome. Second, don't ignore local differences. Central Florida isn't uniform. Micro markets will diverge. First, consider costs beyond purchase price. Insurance, taxes, maintenance, risk of natural disasters all matter. First, if you're an investor, focus on cash flows and long-term sustainability, not just flip potential. Finally, keep an eye on policy. What the governor does matters. If tax structures change, insurance subsidies shift, or migration incentives evolve, those will affect the calculus. If the governor ramps up incentives for out-of-state buyers, that could prolong or prop up the market. If he signals austerity or state budgets tighten due to slower growth, that could increase pressure. In closing, the Central Florida real estate market isn't collapsing in dramatic fashion, not yet. But the shimmer is fading and the foundation is being tested. The governor is reacting, publicly and privately, because when housing starts to wobble, entire states feel it. If you live or invest here or even watch from afar, this story is worth your attention because it's not just about homes, it's about confidence, about migration, about policy, about how regions grow and how they must adapt when growth stops. Stay tuned and subscribe to the channel. Thanks for watching.